All right, let's jump right into this explainer. Today, we're putting on our senior value investor hats. Think of this as an official investment committee memo where we're combining Warren Buffett's strict business quality assessment with some rigorous quantitative valuation to evaluate a stock that's been making massive headlines lately, BuzzFeed, ticker symbol BZFD. And we are going to analyze this strictly using the provided SEC filings, earnings reports, and deal announcements. No outside noise, just the documents.
156%. Yeah, that is the number that completely grabbed everyone's attention. A staggering single-day surge in BuzzFeed's stock right after a major acquisition announcement. Now, look, when a stock goes parabolic like this, momentum traders absolutely flock to it. But as value investors, we don't chase green arrows. We have to ask, does the underlying business math actually justify all this hype?
So here is how we're structuring our memo today. We're going to cover the target in the deal, analyze the business moat, dive deep into the financials, run our quantitative valuation, define our margin of safety, and finally, deliver our verdict.
Okay, starting with part 0, the target and the deal. We need to lock in exactly what this company is right now and the specifics of the transaction that sent the stock to the moon.
Right off the bat, in the SEC filings, we see that media mogul Byron Allen is taking a 52% controlling stake for a headline price of $120 million. He is installing himself as chairman and CEO and sliding founder Jonah Peretti over to a brand new role as president of BuzzFeed AI. Now, on the surface, bringing in a highly experienced media operator like Allen, that looks like a massive win for the company.
But, context is absolutely everything here. Allen is not buying BuzzFeed at its peak. He's buying a deeply distressed asset. Just look at the sheer value destruction since 2021. They bought Complex Networks for roughly $294 million, only to turn around and sell it, along with the prized Hot Ones franchise, for a fraction of that cost just to pay down debt and literally survive. Right before this Allen deal dropped, the company's entire market cap was sitting at a remarkably tiny $28 million.
And honestly, the structure of this deal is where things get really wild. The headline screams a $120 million investment. But the reality? Byron Allen isn't just handing over $120 million in cash. BuzzFeed only gets $20 million up front. The remaining $100 million, that's a 5-year promissory note at 5% interest. Plus, to make this happen, BuzzFeed is issuing 40 million new shares, which means massive 69% dilution for existing shareholders. They're essentially mortgaging the house just to keep the lights on.
Moving on to Section 1, Business and Moat Analysis. Time to channel our inner Warren Buffett and ask, does BuzzFeed actually possess a durable economic moat?
Management is pivoting hard here. Byron Allen explicitly stated that, with the power of AI, he's setting his sights directly on YouTube to build a premier free streaming service. Which frankly begs the question, is this a genuine competitive advantage backed up by real infrastructure? Or is this just the financial equivalent of mashing a generate buzzwords button to get the market excited?
So let's run this through our classic Buffett checklist. Is the business understandable? Yeah, sure. It's digital media, ads, and affiliate commerce. But does it have a durable moat? Barely, if at all. They are entirely at the mercy of third-party algorithms like Google and Meta, which explains the shrinking ad revenues. High returns? Not even close. Returns on equity are deeply negative. So while Allen is undeniably an able operator, this historical lack of high returns and a deteriorating moat make this a super speculative turnaround. This is definitely not a classic value play.
Let's get into Section 2, the deep financial comparison. Time to see what the 10Q and 10K filings are hiding in the numbers. These multi-year trends expose a pretty harsh truth. Revenues are actively shrinking. That Q1 2026 revenue of $31.5 million implies an annualized run rate that is way below 2025. Operating margins? Deeply negative at minus 42.6% for Q1 alone. The balance sheet is loaded with leverage, a total debt-to-equity ratio of 1.74, and check out that dangerously low current ratio of 0.78. Short-term liquidity was totally tapped out. That $20 million cash drop from Allen wasn't fuel for growth, it was strictly for survival.
Putting on our forensic value analyst classes and pulling straight from the filings, the red flags here are literally flashing neon. An accumulated deficit of nearly $695 million since inception tells us they fundamentally struggled to ever build a profitable model. Throw in a massive goodwill impairment, ad revenue tanking almost 20% year over year, and total cash dwindling to just $6.8 million before the deal. Plus, they were staring down the barrel of a Nasdaq delisting. This is the definition of a severely distressed asset.
But hang on, there is one super interesting data point here. Look at the content slice of their revenue mix. While core ads and commerce are rapidly shrinking, content revenue, which covers licensing and custom assets, quietly grew by 69.1% year over year in Q1. It is literally the only major line item with positive momentum, and it hints at the underlying intellectual property potential that Allen is clearly banking on.
All right, Section 3, Quantitative Valuation Models. Let's try to pin down an actual intrinsic value for this company.
Just to be radically transparent with you all, based strictly on the uploaded documents, we don't have peer data for a cross-company comparison today. We are evaluating BuzzFeed entirely on a standalone basis. And honestly, with deeply negative earnings, a lot of standard models just break down. So, to run our Graham formula, we're assuming a standard 4.5% current AAA bond yield to make the math work.
Now, at first glance, BuzzFeed looks dirt cheap, right? Trading at 0.17 times sales and 0.63 times book value. But this is a classic value trap. Because earnings and cash flow are so negative, the EV/EBITDA is negative. And our Graham formula actually spits out a negative intrinsic value because Q1 EPS is minus 40 cents. Bottom line, you are paying for top-line revenue here absolutely zero profit.
And this is exactly why trying to build a traditional discounted cash flow model here completely falls apart. When a company has a history of burning cash, you can't just realistically forecast future free cash flow from past trends. Your entire valuation ends up relying on a highly speculative terminal value, basically crossing your fingers that Allen's unproven AI and streaming pivot is a massive hit. That's speculation, folks, not investing. Which brings us to Section 4, Margin of Safety, the cornerstone of value investing and our buffer against being wrong about the future.
Before we even think about setting a buy price, we have to ask ourselves the ultimate Buffett question. Does the math actually support the momentum? Are we looking at a wonderful business at a sensible price or a distressed business trading at a wildly speculative premium?
Let's compare the market reality with the deal illusion. This deal implied a valuation of roughly $229 million, based on that $3 per share price tag for the new shares. That is a 265% premium over the pre-deal reality. At the post-surge retail trading price of around $1.51, the stock is trading vastly higher than its historical intrinsic value. That completely erases any fundamental margin of safety for retail investors. And finally, Section 5, our final Buffett-style verdict. Let's present our conclusion to the committee.
So, objectively speaking, without predictable earnings or a durable moat, our verdict is a definitive, hard pass for value investors. If you're already in it, it's a hold, but only if you're a momentum speculator. The base intrinsic value is currently negative due to the cash burn, and there is zero margin of safety given that massive wave of impending share dilution. This is a distressed momentum trade, plain and simple. It's not an investment backed by fundamentals.
It really brings to mind that famous Warren Buffett warning. Byron Allen is an incredibly successful operator, no doubt about it, but he is facing a monumental uphill battle against BuzzFeed's legacy debt, incredibly tight liquidity, and rapidly shrinking core ad margins.
So, I'm going to leave you with this one final thought. BuzzFeed still commanded 36.8 million hours of audience attention in Q1. The eyeballs are definitely still there. But can this new management team finally turn those clicks into sustainable cash before the clock completely runs out? Or is this $120 million deal just a very expensive stay of execution? It's going to be a fascinating story to watch unfold, but man, it's a dangerous one to buy into blindly.